Hey everyone, it's Daniel here. Hope you're all doing well. So I wanted to talk about the non-farm payroll report that came out on Friday. So this is a U.S. jobs data report, and it recently came out just on Friday. And so the number came in a little bit better than expected, and we had the headline number, which is the employment number, the number of jobs that the U.S. has added for last month, and that came in slightly higher than the expected number. And we had the unemployment rate come in kind of lower, about 3.5%. So it was quite of a shocker there for many people. And we had the average hourly earnings, which came in higher than, sorry, not higher, in line, and the month over month number coming in line versus the expected number. So the jobs data at 8:30 a.m. is what initially triggered and caused the stock market to basically sell off. Now, when you look at the report was not a surprise, right? It was relatively in line. The reaction that the markets had on the report, you could say was kind of a little bit of an overreaction, in my opinion, because it was slightly it was basically in line. There wasn't much of a surprise in that report. Now, you know, there's many reasons you could attribute this sell-off that we saw on Friday. You could say that, yes, non-farm payrolls was the trigger, but we've been going up and the markets have been rallying and squeezing higher, which caused markets to sell off the other direction, because this rally that we had was just a short-lived, short-term bear market rally, which typically happens in a bear market trend. You do get these rallies. So you could argue that, okay, these are all the longs who went long. They're basically now getting out of the position after this non-farm payrolls report. But really, was it necessary? My question was it really necessary to have a sell-off of an inline non-farm payrolls report? Not much of a shocker, in my opinion. And I would say, not really, right? There was no reason for the markets to really drop heavily like we saw on Friday. Um, Definitely, in terms of a trading point of view, an inline number off, market selling off and then going back to the price level one and then selling off later on, sure. I would be more of an agreement onto that. But just selling off continuously off that number, I would say a little bit of an overreaction. Now, I do understand that I'm not saying that this number is a number that you should go long with. I'm not saying that this is a number that, markets should continue to rally. I'm just saying that it's shocking for me to see an inline number kind of drop this heavily, right? I would have played this or panned this out differently. But hey, markets can do anything that it plans or wants to do. Markets can remain irrational longer than you and I can remain solvent. So let it be what it is, and just let it, do its thing. Let the market do its thing. Now, I want to talk about this non-farm payrolls report and talk about the difference between the establishment survey versus the household survey. So the numbers that you see are mostly the establishment survey, and it's what the markets and what people and the media and the news journalists like to talk about. And I don't like looking at just the establishment. I like to also look at the household survey. And the household survey, in my opinion, is less noisy, in the sense that the household survey doesn't double count the amount of people that are getting jobs. So, for example, if the establishment survey may have one person who has two jobs, it will count it as two. But if one person has 2 jobs or 3 jobs in the household survey, it will count it as one because one person is employed. So if one person is employed, that's, employment. Not that, okay, one person is employed and they've got 2 jobs, so count it as 2 people employed, right? So it can basically double count is what I'm trying to say. So looking at the household survey, you know, also slightly higher. It's having its fluctuations. Very interesting to see that the household survey, the numbers tend to be quite stagnant. So, not much of fluctuations you're seeing there. And especially if you look at the full employment, we're looking at the full employment component in the household survey, you'll notice one thing. You'll notice that the full employment, even though it may have some rises and some decline, the full employment numbers, meaning people who are employed full time, have been stagnant for some time. So the past couple of months, we've seen that jobs have been full employment have been stagnant, and it goes hand in hand with all the news we're hearing about, Facebook and other tech companies and other companies out there that are going out and freezing the hiring process, cutting down maybe jobs and whatnot. And what's very interesting is every time when we see this full employment start to stagnate, it then triggers that against that moment that something is to come, right? Because employers are expecting that, okay, we're not hiring because we believe something down the road, or we're freezing hiring because we believe something down the road is not it's not looking so good, and you know things could end up worse than expected, and we could end up in a very big recession or crash or whatnot. So due to that, we're freezing our hiring, or we're letting go some workers here and there. We haven't made a final decision yet. We haven't gone all out. Maybe some companies have, but we haven't gone all out as an aggregate. And so that's why you're seeing majority of the household survey, the full employment number, kind of just be stagnant, kind of just trending sideways. And I'll try to post a link in the description for you to view that. But yeah, so when you look at that number, we're seeing that number now for this year kind of trend sideways, may have its ups and downs, but mostly not much variation versus what we've seen previously after COVID. We've seen that number really, really, really rise after things started to get better, especially in 2021. But now after that rise, we're seeing it so we've seen it go up and then kind of plateau here. And what's interesting is if you take that and you compare it with 2008, you compare it with 2000, right? The 2008 real estate crash, the 2000 dot-com crisis there. And you look at the past recessions also in 1970s, 80s, and so on, right? You notice the same trend with full employment. So you do see in those era, dot-com bubble bursting, the real estate bubble bursting, where previously the full employment number in the household survey has been rising and then plateauing, and then you got the crash in 08. Same thing in 1990s, 1995, 1998, 1999, right? Jobs were moving up. 2000, 1999, 2000, let's say, we started to plateau, and then the dot-com bust happened, and then boom, you had that full employment number just drop all of a sudden, and it coincides with this recession that happened during those times. And we're seeing the exact same thing right now. So why, again, tying this back to the non-farm payrolls number, we saw markets react and sell off because the whole theme that we've been seeing is that better data is negative. Good data is bad for stocks, bad for equities, bad for the market. Bad data is good for the market because good data basically hints towards higher rates, Fed to do more and whatnot. But I'm saying, hey, we got an inline number. This reaction is kind of a little bit over the top, right? But what you should be noticing, one thing, is that forget about that noise we're seeing in the market. Sure, if data ends up being stronger and stronger, let's say the next non-farm payrolls report or some sort of growth number comes out next month and it's way stronger than expected, then sure, I understand why markets would sell off, because they would think that the Fed is going to raise rates more aggressively. But what I'm saying is, hey, look at the household survey. Look at the numbers there. Look at how the numbers been constant for some time, and compare that. Look at the full employment part and compare that with 2008, 2000, and the previous crashes out there, that we see the stagnant move, and then after a big move up, then we see a stagnant move, and then we get the reversal down. And we're seeing that right now. We've seen it go up in 2021, and then now we're stagnating here, and then dropping, right? So same thing that we're seeing like we saw previously, and that should be more worrisome than an inline report that we saw on Friday. Yes, we already know the Fed is going to continue to hike rates. We know they're going to be aggressive. But what you want to watch out for is the effects of these interest rate hikes, right? So also we have other data coming out like CPI and inflation and whatnot. So the probability of a 75 basis point rate hike in November could still change, but what you want to be focused on is the job market, the unemployment rate, yes, but the full employment component in that household survey. Once you start seeing changes in the household numbers coming in weaker than expected, especially if the establishment is not showing it, then that's your sign that, okay, looks like something is tipping over, something may be breaking here. So anyways, let me know what you guys think in the comments. If you like these videos, you want to hear more, subscribe, hit the bell icon as well, give a like, share this with your friends and family, and if you have a topic in mind that you want to talk about, again, leave it in the comment section, and I'll take a look, and maybe I'll do a talk on that as well. So anyways, I'll see you guys around. Good luck, and talk to you later. Bye.